Hello, everybody. In today's session, we are going to be talking about options. I'm going to continue what we started on the last video from Friday, whereby I showed you how I like to trade options on expiration days. So the example I gave you on IBM on Friday was whereby the option was costing us about $20, and IBM ended up going up about $2 from 200. And by the end of the day, the stock reached 202, and the option were worth about $200 each one. So that's about tenfold. But before I show you and go into it, I want you to understand the risk of options. First of all, options is not for the faint of heart. Trading options, I think, as a whole today is kind of a gamble because the premiums are very, very high today on options, whereby they are charging a lot of money for the right to buy the calls or the puts on options. And it's like that in most of the stocks. In options, when you're buying an options, for instance, an IBM, and we bought an option for $20, that IBM would be above $20, about above $200 on the close of Friday. If we were to get that wrong and IBM was going to close at 199.99, the whole entire cost of the option, which was $20, would be lost. We would lose that money. So if we bought 10 contracts at $200, we'd lose the whole entire $200. So in a way, it's like being in a casino. I kind of recommend trading options only if you are a trader for a couple of years, you know what you're doing, not for people who are trading for long-term investments. This is something you need to learn how to trade and understand what's involved in trading. But there is a significant amount of risk in trading options. With that being said, let's dive in and let's look at that trade in IBM and see why that trade worked out for us. So as we can see here, IBM is making all-time highs, keeps going up every single day of that week. You're looking at a 5-minute chart here, and I'm going to go back a little bit, maybe show it to you a little longer time frame. So as you can see, this is a 20-day time frame. Each bar is about an hour, and IBM is on an uptrend. Its all-time highs were 206, I think 13 something, which was made in 2013. Okay, and that's the number that I believe IBM is trying to reach. It's trying to go back to its all-time highs. This week, they were able to break the 199.18, which was the last high, and they reached on Thursday. As we can see here, it was 201.12. Now we're going to go into a smaller time frame. And the way I was thinking was, we came in on Thursday with good economic data, right? From also last week, there were good economic data. So the economic data is actually playing in favor of the Fed. The S&P is a little extended, but it was trying to continue going up. We saw the small caps going up. We saw the equal weighted going up. There were a couple of sectors that were making all-time highs, which was giving us an idea that some stocks are strong, and the ones that are strong, you can try to continue taking them further up. Now, usually, if I look at options at the beginning of the week, you see we're now entering a new week, which will expire on September 6th. So if I'm looking right now, IBM is at 202. If I'm looking at these options, right, the calls for 202.50, they're costing me about $1.44. That means that each contract is going to cost me $144. But on Friday, because this is an expiration for the end of the week, on Friday, that time cost, the time value has disappeared, and the stock and the option was trading for 20 cents. So one contract, which is 100 shares times 20 cents, would cost me $20, right? The stock opened at around 199.18, which was a previous high, went up to 200 and started coming back in, came all the way back into the previous close. And this is where you need to make a decision and say, okay, is this market going to go up? And if it's going to go up, maybe it's worth it for me to invest $20 in this option. It's not that much money. And if this stock does go up, I'm going to be making every single penny above $200. And that is what happened. It was fortunate enough to happen because of the fact that the market went up, the market was strong. It was a Labor Day weekend. Usually, if things are good, fundamental data is good, technical data looks good, then it's worth it to take that type of trade, right? And if you are right, then you can make some real money. And that's what happened here. Once IBM broke $200, it started going back up, went back up to the high that we had last time, 201.13, and then it continued all the way back, all the way continued to 202. So technically, every single penny that it's going above $200, you're making money because you're owning, for every contract, you're owning 100 shares. So when we bought 10 contracts, $200, this thing went to 202. If we would have held the 10 contracts all the way up there, that's a $2,000 profit on a $200 investment. So on Fridays is pretty much the only day, on expiration day, it's pretty much the only day I see that it's worth it to play these options at a very low cost, because you're not paying for the time value of owning these options. There are other ways I am holding options. If I get into a stock and I'm not sure if the stock could go down or if it's going to go up, and I'll give you an example just so you could get an idea. So let's take a look, let's say, at Mobileye. Mobileye is a volatile stock, okay? It's owned, it was owned by Intel, most of it. And Mobileye came down to its low from where it went public, somewhere around the 25, 24 something dollars. It went back all the way up to $33. That's a serious move. Came back down to 25, went back up to $33, 33.71, right? That's a considerable amount of size move for a stock that's that costs $25 within such a short time frame, and then it comes right back down. This is volatile. Now, this is a stock, if I believe I want to buy it again at $25, right? I am taking a serious risk. Plus, a lot of news could come out, and then the stock could fall out of bed again. So in stocks like this, I do prefer to play the options as opposed to overnight, if I'm playing it overnight, as opposed to playing the stock itself. Okay, this is something that's interesting. Now, if I'm going to hold the stock, I want to hold it, let's say, for the long term. I say to myself, you know what? I believe Mobileye is going to go up in the next few months. I'm going to buy it at around $25. If I am wrong, and look at this, what happened to Mobileye, fell all the way down to 13. That's about a $12 loss. If you're only 1,000 shares, it's a $12,000 loss. But if in a very short period of time, also, this happened, if we're looking at this, this happened, let's say you would have entered the trade somewhere around the end of June or at the end of August, that's 2 months, okay? So holding a stock like this, you would have lost $12,000 if you would have taken a put, let's say, to protect that position. The put would have cost you somewhere around $2,000. You would have lost $10,000. That's like, you know, a considerable protection in a way if you are wrong. And believe me, I have a friend who did this. He didn't want to get out when I told him it's breaking all-time low. I said, this stock is breaking all-time low. You should you should get out. He said, no, this go back to $33. So at least buy yourself a put to protect yourself. Nah, I'm not going to risk $2,000. I believe this is going to $33. And lo and behold, the stock goes down to somewhere around 13, the lowest 13.16. So that is another way that I will play options. There are some other ways to play options, obviously, but these are the two that I'm going to cover with you today. So I hope you enjoyed this video. Don't forget to subscribe, give us a like. If you want to learn how to trade, GalTrades.com. I hope everyone has an amazing trading week this week, and we will see you on the next video. Thank you.